All right, thanks for joining me. I'm starting the recording right now. We're going to talk about seller financing today. So let's go ahead. I'll share the screen. And we're going to jump right to this SkySlope application. All right, because this is live, for those of you that are joining me, I'm going to have to hide the Zoom windows over on the side. So I'm not going to see you raising hands or anything like that. So if you have questions, and the benefit of attending live is to ask the questions, and I really want your participation. So those of you with more experience, you can chime in and share your experience as well, but unmute yourself and chat with me. If you type it into the chat, then usually that will pop up as a bubble for me and I can see that. But otherwise, I have to move the window out of the way so that I can actually see the form so that we can talk about it. Okay, first of all, where do you find these forms? If you go to utahrealestate.com, over here, you go to the forms section. You can either go down to the forms library, and the easiest way to find a form down here is if you're not exactly sure of the name of the form, but you think you know part of it. So, for example, if we're talking seller finance, you can type in seller, and anything that has that word seller in it, you'll find it right there, okay? The other way that you can do it is forms. You can go to SkySlope forms, and this is where you can actually fill out the forms. Now, my opinion on this, guys, is if you love SkySlope, great. Fill your forms out on SkySlope, save them as a PDF, and then pull them over to .loop for our electronic signatures. The reason why we use .loop and not SkySlope is we did look into SkySlope on a corporate level, but .loop does more for us than just filling out forms and electronic signatures. Okay, .loop has some programming back-end stuff that we use. First of all, it helps us be compliant with the state's regulations of keeping on file every transaction for a minimum of 3 years. So we're in compliance with that with .loop, but we also can do a lot of back-end programming that works with our software for payroll and other things like that, which we cannot do with SkySlope. So that's why we use .loop instead of SkySlope, is for systems that are kind of operating behind the scenes for you guys. So I still like SkySlope for the forms, for filling it out, but I'll pull it over to .loop in a PDF format and send that off to my clients for signatures. Then I've got a permanent record in .loop that my clients have seen it, because .loop shows me that. I've got a permanent record that they've signed it. And when it's shared with them, I've got a permanent record that it's been shared with them. And those things are required by law. All right. So that helps me stay in compliance with the law. So here's the seller financing addendum. So this is going to go along with the standard real estate purchase contract. This is just an addendum that's describing the terms of the seller financing. Now let's talk really briefly before we get into this. Why would I want to do seller financing versus a lease option? There are pros and cons to each of them. And so really briefly, seller financing means that I'm selling the home. All right. I'm acting as the bank, but I'm selling the home. The buyers that are coming in, they will be on title. And that means that they'll be paying the taxes if, that they're the actual owner of the home, they're not a tenant. And so if things break down on the property, it's their responsibility to fix them. And so it's much easier than being in a landlord position, where you're not getting called up with, hey, we're having problems with plumbing, come out and fix everything. So that part's easier for you. But because you've sold the home and you're financing it yourself, it means that also those, if the buyer stops making their payments, now you have to foreclose on them. And so just last week, we had a CE class where this came up, and we talked about foreclosure and how long it can take. And if you're foreclosing yourself, then you can do it. I think he said, this was Tucker that taught the class. Tucker, I think his last name's Hodgson. If I'm wrong, you guys can correct me. But anyways, he said about 5 months to foreclose on somebody. Whereas evictions, if you get an eviction attorney, you can get that done possibly pretty quickly, but on the outside, maybe a couple of months. So it does take a little bit longer to do a foreclosure than it does to do an eviction. Now, so some of the benefits with seller financing, we'll go through it. here, and we'll talk about some of the risks and how this form will help you mitigate both those risks and help you have the benefits as well. So the idea is we're selling the home. We're not going to be on title anymore, and that creates some unique challenges. So this first part here, really easy. We're just, here's the reference date of the offer between the buyer and the seller. And then the address of the property.
Eric, can I interject real quick something on that?
Absolutely.
This has come up with a couple of people. When you do seller financing and the buyer purchases that property from you, they now have that loan and they have that property. If that buyer subsequently files bankruptcy for any reason, that property is going to get pulled in. So if your client was the seller and they seller financed it out and the buyer then has financial difficulty down the road, they then are going to tie that property and the underlying mortgage into it if you had a loan on it. If they get a judgment from somebody, that's going to attach to that property. And then if they don't make their payment, it's still attached to the property, even if so there's some other issues that come up potentially to be aware of when you're doing that, just outside of the forms of doing it right. But that kind of doesn't get touched on, I think, sometimes by agents when they're talking about this. The person who had to deal with that had no idea that was even a risk, and they reached out to us. So just something to be aware of, that you're basically tying, as a seller, your financial future into your buyer's ability to continue to make payments to some degree and not be in bankruptcy.
Thank you, Alan. I think that's a great comment. Much appreciated. Okay, let's go into the first one. And this brings up to me, along with what Alan said, this brings up the discussion for one of the bigger risks associated with seller financing. And so we're talking about credit documents. Seller's extension of credit to buyer shall be evidenced by, and now we get to check something, note and deed of trust, or note and all-inclusive deed of trust, or some other instrument. All right. And this is referred to as credit documents afterwards, and it's recorded against the property at closing. Now, you guys know when you get a mortgage, there's a note. So that's part of the closing documents. The buyer goes at closing, they're signing everything, and there's the note and the deed of trust there. That's part of their closing documents that's recorded at closing. So this is your chance as a seller to have the same thing, and you're recorded there on the note. So what's the difference between note and deed of trust and note and all-inclusive deed of trust? Now, some of you experienced agents might know, but some of you brand new agents might know as well, because they do cover some of these things in real estate school. Does anybody, if I stop sharing my screen, anybody know the difference between note and deed of trust and note and all-inclusive? Alan does? I bet Rebecca does too. Alan, do you want to go for it? Like why? Because all-inclusive, quite frankly, sounds better, doesn't it?
It does. And it's really important that if somebody's going to do seller financing, they use the right one.
Yeah.
So an all-inclusive, go ahead.
Let me just say this really quickly. If I'm guessing, I'm going to guess all-inclusive, because that sounds really good. Like, we want to include everybody, right, Alan? I mean, this is a world of
what you need.
This is a world of inclusivity. So this is a great example. The point that I'm trying to make here is this is a fantastic example of why you guessing on forms is never a good idea.
Yeah.
Okay. Because people aren't hiring us to guess. If you don't know the answer, then you say, you know what? Let me call somebody, and you're going to call me, and I'm going to say, did you watch the video? And you're going to be like, no, what video? And I'm like, attend the trainings, damn it. So anyways, you guys are here, you're attending, you're winning right now. But Alan, what's the difference, and why is the all-inclusive maybe not necessarily our best guess? What does it mean?
Well, I'm going to talk about what that is, then maybe I want to hear what your thoughts are on why it's not the best guess. So an all-inclusive trust deed, you might hear it referred to as an AITD, so all-inclusive trust deed, is essentially a wrap mortgage. So you've got a mortgage on the property, you're going to sell it as seller financing. That AITD is going to basically say the seller is buying the property subject to the existing mortgage, and the new loan is wrapping around it. The reason why it's really important, if they use that one, if there is an underlying mortgage and you don't use that language, when the buyer goes to refinance that property down the road, which is the end goal of these typically, and pay off the seller financing, if you use just a note and it didn't specifically specify the all-inclusive trust deed, there's now two trust deeds on here, and the underwriter is going to have a really tough time making sense of it, and you're probably going to have a hard time getting financing on it because you used the wrong document up front when you do that. The other issue that you want to be aware of an all-inclusive trust deed for your clients is when they sign that document and they sell the property with seller financing, if there is an underlying mortgage, that underlying mortgage has something called a non-alienation clause built in, which means that the owner of that property is not going to change title to the property without written permission from the lender, and the lender will never give you written permission to do seller financing. So when you do seller financing, you're violating the terms of your initial trust deed if you have a mortgage, and you're now in technical default. And the remedy for that default is that they can require you change the title back to your personal name. And that becomes really sticky if you did seller financing. So you just kind of have to go in knowing that's a potential issue, and make sure that you've advised your client properly on the risks so they can make the decision and they don't come back and say, well, you didn't tell me. But that's why I would use an all-inclusive trust deed. I'm curious, Eric, as to why you would not use an all-inclusive trust deed.
Okay, so my point here, and Alan gave a great description of what it is, but my point here is we can't just guess. Like, one of the forms is appropriate for one scenario and one's appropriate for another scenario. If I own my house free and clear, then I'm going to go back to sharing the screen and we can look at that form. If I own my house free and clear and I want to do seller finance, then I'm going to use the note and deed of trust, right? Because there is no underlying mortgage that I need to include or wrap around. But most people don't own their home free and clear. And so they're going to be needing to do that note and all-inclusive deed of trust. And so my point earlier of saying that we can't just guess because this one looks like it's more comprehensive because it's all-inclusive, that's not the point of the form. We're not different levels of inclusivity here. This has nothing to do with political correctness or anything like that. It's, is there a mortgage on the property or not that needs to be wrapped with this note or not? And if there isn't, if they own it free and clear, then we're going to do the note and deed of trust. If there is, and we need to do that wraparound, as Alan explained, then we need to do the all-inclusive deed of trust. It's just a question of what is the financial situation, or the situation on the mortgage. Is it paid off or not for that seller? And then we know how to do it. All right, next, Alan, is that the?
I think you're on it. At what level would you recommend an agent get involved in explaining the risk of some of those things? I mean, at what level do you step past your role as an agent when you're explaining those risks of seller financing? Like, how would you advise people to deal with that?
That risk is actually,
what role do you need to advise?
The primary risk is that due on sell clause that's going to be triggered, potentially triggered, right? And that is actually further down in the document. So we'll get to that. But yeah, we want to be, again, our fiduciary duty says that we're going to say everything that we can. We're going to disclose all the information that we have to help our clients make a good decision. So we're not going to hold anything back. At the same time, we're not going to say, oh, this is bad, because it might not be bad. Maybe it's a good thing for their situation, but this is the part of this training, is knowing, is it appropriate for their situation, or are the risks associated with it maybe not outweighed by the benefits? And understanding how this document works and how we can use it will help us best advise our clients. So I think that's a good part of this discussion, is not just understanding how the form works, but this whole process, and whether or not it's something that we can recommend, or maybe not even recommend is the right word, but something that we can, we want to make sure we can adequately explain the risks so that our clients can make an educated choice on their own. All right.
Hey, Eric.
Yes.
So going off of what Alan just said, couldn't we refer them to a title company and have the title company explain what the difference is? I mean, we can give them the down low, but would a title company be a good resource to help them make that decision?
A title company is a great resource, and we'll also be talking about some of the things below on this form that a title company can do for us, but we're the ones filling out this contract. All right. And we're the ones that have the legal obligation. It's not title's obligation to understand these forms. I mean, if we're sitting our client down filling out these forms, we can't shift that blame on title. If they got into a bad situation, they're going to say, hey, this is what my agent told me to do. And we're going to be like, well, this is what title said. It doesn't work that way. So we cannot waive our liability there by just shifting everything over to title or to a lender or anything like that.
I just meant as a resource to help ease their mind,
Yeah, no, they're a great
They could
resource.
speak more, yeah, they could
and-
speak more knowledgeably about those, because I'm a little bit shaky on those. I didn't know the difference, so there you go.
And they can, as far as the note and deed of trust and note non-inclusive, yeah, absolutely. Title company would be great to explain that to somebody. So if you're still not, basically, in a nutshell, you're going to use the all-inclusive deed of trust if there's still a mortgage on the home. If the seller owns it outright and there is no underlying mortgages, then you'd use the note and deed of trust. Okay. But we'll talk about some of the risks associated with an underlying mortgage that comes along with this. That's the biggest one, in my opinion. All right. Then we've got creation of documents. The following party shall pay for and be responsible for the creation of the credit documents, which is basically this note and deed of trust, because here it's hereinafter credit documents. All right. So who's going to pay for this? Buyer or seller, it depends on who's negotiating for what. If it's me, I'm going to prefer that the buyer pays for things. But there are some things that the seller is going to be doing and are responsible for as well. And the credit documents, in other words, that note up there, shall contain a due on sell clause in favor of seller. All right. And we'll get to that a little bit below. So I'm going to hold off on that discussion for now. All right. Delivery of the credit documents. We're going to provide the credit documents, which is this note, to the other party no later than the seller disclosure deadline, referenced in section 24A of the REPC. So right up at the very front, the seller disclosure deadline, we're going to get this note there so that everybody can review it. And then the non-party, whoever didn't create it, they get to review that note, the terms of the note, and make sure that they're okay with it. If they're not, then this ends. Earnest money goes back to the other party. So it would be released to the buyer. And again, that has to all be done no later than that due diligence deadline. So everybody gets a chance to review everything there. If the non-creating party, so for example, if the seller creates that credit document, the note, and they send that over to the buyer reviews it, and they don't cancel the REPC, then they're waiving the right to cancel the REPC based on the credit documents. So basically, they don't have to give some verbal authorization or written authorization to continue on. They have a chance to cancel, or they don't say anything and the deal moves forward. Now, the terms of the credit document. So these are the terms in the note that's going to be recorded on the title of that property. We're going to outline all the terms. And so this is just like a bank's loan, right? So we've got the principal, the interest, and this is where you could possibly involve your lender and say, hey, what do you think some good terms would be? I've never set the terms of a loan before. What are today's rates? If I'm a seller, I might want to get a little higher rates than today's going market rate. Or maybe in order for me to sell this, I'm going to offer better terms than I can get on today's rate. Maybe my underlying mortgage is for 3% and I offer this at 5% seller financing, and it makes my property more attractive, more marketable than a going rate of 7%, something like that. That's up to you. And all of these are negotiable, but sometimes sellers will get a higher rate because they're like, hey, we're giving you a loan on a home when you cannot get a loan yourself. That's why buyers usually go this route, is for whatever reason, they cannot get a loan themselves. And so I used this a few years ago because a guy came to me. He didn't have credit problems, but he had just started a new business and he needed a 2-year history in that business and he didn't have it. And so we did a 2-year seller finance, and I can't remember if we did seller finance or lease option. I think we did a seller finance. Anyways, I did seller finance with him with some of the surrounding land. I don't know on the house. I might have done a lease option with the house, but I did do some seller financing with some of the land around it. Anyways, so we picked our terms right here. Remaining principal due amount in, let's say you want a balloon payment, by the way. Let's say I want to do 5 years. So, or in my case, in my scenario, he needed about 2 years history as self-employed working for himself before he could get a loan. And so we had the remaining principal amount balance due in 2 years. Basically, that's a balloon that says, I'm going to loan you all this money amortized out over 30 years. but you're going to pay me the full amount owed in 2 years. And if you've ever looked at your amortization schedule on your mortgage, they haven't reduced the principal balance hardly at all in the first 2 years. And so, you could do seller financing. Somebody could be paying you, a few $1,000s a month. And, over the course of 2 years, they've paid you $24,000. Let's see, if it's $2,000 a month, they've paid you $48,000 in 2 years. And the principal balance of that note has gone down maybe, I don't know, $5,000, $6,000, depending on your interest rate. So it might be a good thing for you. And then you say when the first payment is due, and if there's any other terms that you're going to outline, then you've got a chance to put that together. And again, you would take this, as Rebecca said, you can take this to the title company. So you could have a discussion with your lender. What do you think good terms would be if you don't understand all of these terms very well? It's a great chance for you to understand that a little bit better by having a sideline conversation with your lender. But then you can take this to the title company and they'll help prepare the note for you. So, you're not drafting a note, you're not Googling notes on the internet and filling something out. You would take this to title and they'll help prepare that note for you, which again, you would be the creating party up here. Let's say the seller's creating that, and then they would provide that to the buyer by the seller disclosure deadline. And then everybody has until the, no later than the due diligence deadline, to review all of that and make sure that those terms in that note are good, is what you agreed to. All right. And then we've got late payments. And again, this might be a good conversation to be had with title or lender, or you could look at your own note and see what kind of a late payment is built in, what kind of is a standard thing. And you can put that in there. And again, this is negotiable. You don't have to do exactly what a bank would do to you. You can make it more painful. It's all up to your client. All right. So right here, it says all or part of the principal balance on the note may be paid prior to maturity without penalty. That means there's no early payoff penalty. All right. Seller agrees to provide to buyer at settlement an amortization schedule based on the above terms. So how many of you guys know, if I stop sharing right here, how many of you by raise of hands know how to build an amortization schedule? Alan, you're cheating.
Well, I'll tell you, Eric, the thing I'd recommend, and I'd like your opinion on this. I get calls fairly often from agent referral partners that we work with about this. And what I recommend to people is, if you're going to have a seller financing situation, you probably ought to have a lender look at the buyer and essentially underwrite them like they would for a loan, and determine what the relative risk is of that person and how long it's likely that they're going to need to carry the financing, to determine what those terms are. And then that same lender could also, in 15 seconds, provide an amortization table that could be provided and used. Is that good advice? Is that bad advice? How would you modify that?
I'm going to go back to the form, because that is covered in this form. And I love the things that you're bringing up as risks, Alan, because it's nice to see that all of your concerns are actually addressed in the form. Okay. So we've got, when we talk about the amortization schedule, so the seller has to provide an amortization schedule. They've got to provide a written disclosure of the total interest buyer will pay to maturity of the note. So they're calculating that out, just as a lender would. And what is the APR of the note based on loan closing costs? So yeah, this is a great opportunity where a lender can help you do that, because we don't have the software or really the know-how to do that. Also a title company. So when I did my seller finance, the title company provided all that to me. So these are your friends, title companies, mortgage lenders. You can talk to them and they can run these things for you and help you out. Don't wing it though. All right. We're not trained to do that. We're training you on how to fill out the forms, but we're not financial experts, and you don't need to be. Okay. Sorry. Slow screen, whether it's SkySlope or my computer, I don't know. What is this doing? Okay. All right. Down to section 3. Buyer's going to be responsible for property taxes, HOA dues, special assessments, hazard insurance premiums on the property. And this is one of the benefits of not doing a lease option. Because usually with a lease option, you're the landlord, you're still paying for all of these things. This is also, some of these things are a benefit for a buyer because they can write off some of these things. So, you can write off your mortgage payment as a buyer. So that would be a benefit for a buyer to do seller financing. Whereas with a seller, when it's a lease option, you're still owning the property, you're making those payments, and you can maybe write off some of those payments. So anyways, those are some of the benefits on both sides and part of the discussion that can be had with your client, be it buyer or seller. Now, they've got to pay these, but who's getting paid, right? So is the buyer paying directly to the county treasurer or the insurance company or whatever, or is it going to an escrow agent on a monthly basis? My recommendation on this is if you own the property outright, then you have a little bit more flexibility as a seller on how you want to do this. There's not as much risk involved, but still, if I were to give a blanket answer, I would almost always prefer to have it go directly to an escrow agent on a monthly basis. And there's a discussion a little bit further down. Okay, whether the payments right here will be made to the seller directly or an escrow agent. And again, I like the escrow agent. And there's a couple reasons why I like this. Again, me and Alan have been doing this for a long time. Some of you agents have as well. You may remember some of the crazy stuff that went down. I base everything around 2008 because that was a really wild benchmark there. But we had problems with people doing these types of transactions where the buyer would move in, seller financing scenario. They're making their payments regularly to the seller, and the seller isn't paying off the underlying mortgage. And so as you guys, as we learned last week when we talked about this in our class, it can take up to 8 months through the foreclosure system for a bank to foreclose. And so seller's not making the underlying payments. The bank doesn't start foreclosure for a long time, which means that the buyer is dutifully making their payments, thinking everything's good. I'm the homeowner. I'm doing a real good job. And all of a sudden, 8 months in, they've got a notice of foreclosure posted on their door. And they're calling us up saying, whoa, what's going on? I'm making my payments. How come I'm getting foreclosed on? Well, it turned out that seller wasn't going on and paying the underlying mortgage. And so the buyer's getting, well, they're getting defrauded, basically. I was going to say they're getting screwed, but we can be a little bit more professional here. So I like using an escrow agent. There's a company out there called Escrow Specialists. Let's see. Maybe that'll show the whole thing later on. Anyways, Escrow Specialists is the name of the company. And you can choose, sorry, I've got people jumping in and out. Looks like they're having connectivity problems. Are you guys all, I'm going to stop sharing really quick and make sure you guys, it's the connectivity problem isn't on my end. Are you guys all with me still? We're good? Okay. Sorry, one of our agents is trying continuously to get in. And want to make sure it's not on my end. All right, so we're going to use an escrow specialist, and then you can choose whether the cost of setting up and maintaining that shall be paid by the buyer, the seller, or split evenly between the parties. It's not super expensive to do. This isn't a real I mean, if the seller is doing a favor to the buyer, and if it feels that way, then the seller can have the buyer pay this expense. Like, hey, you could never get this if it weren't for me giving you this, this type of financing. So you're going to incur all the costs. If it's a seller trying to get their home sold, and so they're making up more favorable terms, then they could split it or they could pay it themselves. It all depends on the situation. There isn't a right or wrong answer, and everything's negotiable. All right. So if the credit documents are for a note and all-inclusive trust deed, then the seller shall provide buyer with evidence within 10 days upon written request by buyer that the seller is making their current payments as required by the seller's underlying mortgage. So again, when you're paying escrow specialists, they automatically pay that underlying mortgage for you. So that removes that risk from the board for the buyer. It does cost a little bit more here, but it gives everybody peace of mind that that underlying mortgage is being paid. All right. And again, we can have the same thing be applied to property taxes, HOA dues, special assessment, whatever. Okay. So we can have escrow specialists make sure that all of those things are paid so that we're not getting a tax lien on the property. You know, and Alan had mentioned that as one of the risks of, you know, being a seller financer, is that other people could put liens on the property that could potentially jeopardize your position. Taxes is one of those. All right, let's talk about the due on sale clause. This is the big risk. So in all the mortgage documents that your clients are signing when they buy a property with a loan, there is a due on sale clause built in. Hey, Alan, are there any loans out there that don't have a due on sale clause?
I'm not aware of any. I mean, Fannie Mae, Freddie Mac, FHA, VA, USDA. Maybe there's some non-traditional, like non-qualified mortgage type loans that wouldn't have that, but even those that I've seen, I haven't seen anything that doesn't have some kind of clause in there buried in the terms.
So the odds are that there's going to be a due on sale clause. What due on sale means is basically that, hey, we're going to, you know, this is the bank saying to the buyer, we're going to give you this loan so that you can buy this property. But when you sell this property, you need to pay this loan off, right? That makes sense. But what we're doing here is the seller is selling the property and not paying the loan off, because in most cases in a seller finance situation, in some cases, a seller may, maybe they only owe $100,000 left on their mortgage, right? So they're going to do seller financing, and the buyer coming in that's doing the seller financing, they can't get a loan, but they do have a bunch of cash, right? So maybe in my scenario, it's a businessman. It's not necessarily a bad credit. He's not necessarily a big risk in that regard. He makes good money. And so he might be sitting on enough cash, and he might give me $150,000 down as part of his down payment. And then I'm going to finance the other, you know, $600,000 for whatever terms we agree on. In this case, with that $150,000 down, and I only owe $100,000 on my mortgage, on my remaining balance, I can pay off that balance with this. And then I'm not going to trigger a due on sale clause because I am selling it and I'm paying that off. But what if I owe $500,000 on my mortgage still, and the buyer's going to bring in 150? Well, that's what we're talking about. I'm selling the property now, but I signed as a part of my, you know, as part of my terms at closing, when I bought the home, I signed accepting this due on sale clause. So I'm selling it, but I'm not paying the mortgage. So let's read through this. As part of the seller disclosures referenced in Section 7 of the REPC, so this would be an extra disclosure now that you know, goes along with all the other disclosures referenced there. The seller is going to need to provide to buyer a copy of their underlying mortgage so that they can see what this due on sale clause is. The note secured thereby, and the note again just defines all the terms associated with that loan and the amortization schedule. And that basically says, okay, this is when we got the loan. Here's where we're at in the amortization schedule. So you have a pretty good idea of how much is still owing on that property, if applicable, meaning if there is an underlying note. So that's what the if applicable means. If there is an underlying mortgage still in place, then yeah, you're going to need to provide all of this stuff as part of your seller's disclosures. Buyer's obligation to purchase under this REPC is conditioned upon their approval of the content of those documents in accordance with Section 8 of the REPC. If the seller's underlying mortgage becomes due as a result of this transaction, meaning the lender exercises their due on sale clause. Now, you'll talk to a lot of investors that will do this type of thing. Alan, back when I worked for you 20 some years ago, the rule was that you could own up to 4 property. You could get loans, basically financing for 4 different properties. But as if you're acquiring a lot of properties, banks stop giving you loans after 4 or so. Is that still a rule, or?
Conventional loans, you can have up to 10 finance properties now.
Okay.
That either you're on, or that's on your credit report, or that's on your credit, that you owe on, or that's on a tax return you file jointly on, and still get a conventional loan. You can go beyond that, but not for conventional financing.
Okay, cool. Thank you. That's a good update for me as well. So let's say that I've got a major investor and he owns more than 10 properties. Seller financing is one of his only options to do. All right. So he can go on and he can buy more properties. It doesn't mean he has to stop at 10. He just can't get a traditional mortgage or a conventional mortgage beyond 10 properties. So seller financing is an option for him. Now, so again, I was saying that a lot of investors will say, you know what, I've talked to investors, they're like, we've done this 1,000 times and we've never seen it exercised, but it can be exercised. And so you never want to get yourself in a position where you're saying, oh yeah, they can do it, but they never do, because the minute you say that is the time that they actually do. And the conditions for doing that are actually pretty ripe right now. So let's say that I'm a bank and I've lent out my money at 3%, right? And this actually goes along with our discussion earlier that Alan, where he started out with his mortgage minute, which I didn't record for this video, but Alan talked about some of the recent, the bank seizures by the FDIC. So let's say that I'm a bank and I've lent out, hundreds of thousands of dollars at 3%, and today's rate 7%. And I find out that one of the people that I lent it to has sold their home, and I can recapture all that money. I can get all of that loan paid off by exercising this due on sell clause, and then I could loan it out again at 7%, whereas right now I'm only getting 3% on it. So this is one of those times where a bank might be properly motivated to exercise their due on sell clause. Most of the time, banks, if they're getting their payments, they don't care. Hey, we're getting paid regularly. That's good. We're making money on it. We're happy. But in a market shift like this, where interest rates have jumped up quite a bit in a short period of time, it could be a reason why a bank would want to trigger a due on sell clause. So if the seller's underlying mortgage becomes due as a result of this transaction, because as Alan said, all of them do have a due on sell clause built in, then the buyer agrees to pay the remaining balance owed and due on seller's underlying mortgage. Now, this is a big discussion that needs to be had. So as part of the seller's disclosures, we've got a copy of that underlying mortgage. We've got a copy of the note. We know the amortization schedule, so we know pretty roughly within, $1,000 or so what that balance owed is. And we're accepting as a buyer that risk that, hey, if we do this transaction and the seller exercises this due on sell clause, as they can, by the way, this isn't illegal. Okay. So yes, the buyer signed that they're going to pay the mortgage. There's the due on sell clause built in. Nobody's going to go to jail if you do this. This isn't a question of illegality. It just triggers a clause in that note that says, hey, we've sold the home, and the bank, as part of their terms, says, okay, then we want all of our money back. Okay. So there's nothing wrong with doing that. But if that due on sell clause is triggered, then the buyer's got to come up with the full amount. And if they're not able to do that, then that's bad news for both the buyer and the seller. Okay. Because then now the seller is facing a potential foreclosure action on them. The buyer, if they've put down any amount of money, if they put down their $150,000 to secure this financing and they can't come up with it, then yeah, everybody's kind of in trouble as a result of that. So in such event, the due on sell payment shall act as a payment towards the principal owed on the note. So this is saying, the buyers moved in, the note, this due on sell clause was triggered. They've come up with the extra money. They scrambled, they got a hard money loan, they got a loan from parents, whatever. Maybe enough time had passed that a new loan program opened up and they could get that permanent financing. And they did pay off that mortgage. So maybe they didn't pay off the whole thing. Maybe we've seller financed $700,000 and the mortgage was for $400,000. All they have to do is pay off the $400,000. And then it says down here that the buyer shall still be obligated to the terms of the credit documents if any balance of the note remains after the due on sale payment. So we seller finance 700. The underlying mortgage was for 400 when they exercised that due on sale clause. We scrambled. We came up with a way to pay that $400,000. And now there's $300,000 still owing with the terms of the note that we established up on that first page. And this survives closing. All right. So any questions on that part? If there are, again, you have to actually unmute yourself because I can't see. I have to close certain windows in order to see the forms. Okay. So let's move on here. The buyer has provided to seller a required part of this addendum, the attached buyer financial information sheet. Now, this is a form available also on the MLS, so you can get it in SkySlope Forms. The buyer financial information sheet, if we click to that, this is the kind of stuff that Alan was talking about, where it's the kind of things that a lender is going to ask them as, getting pre-qualified for a loan. So again, if you're working very closely with a good lender like Alan, and you're a seller considering doing seller financing, you might want to, this is a required part of this form. They're going to fill this all out and give it to you, but you may want to say, you know what, I want you to talk to my lender, and he's just going to do a credit check as well, and make sure that I'm comfortable with this risk. Okay. But that buyer financial sheet is required as a part of this addendum. Okay. The attached buyer let's see, buyer may use the buyer financial information sheet approved by the Real Estate Commission and the Attorney General's office, or may provide comparable written information in a different format together with such additional information as seller may reasonably require. Is it reasonable that a seller says, hey, go get pre-qualified with my lender? Absolutely. And by the way, the lender can charge for that. Credit reports aren't free. The lender can say, all right, I'll do this for you. It's going to cost this much. And there's nothing wrong with that either. All right. And then the buyer shall or shall not provide sellers with copies of IRS tax returns for the 2 preceding years. Again, if they were getting a mortgage, they would absolutely have to require that. So why shouldn't you require it? The buyer acknowledges that the seller may contact the buyer's current employer for verification of employment as represented by buyer in the buyer financial information sheet. Alan, are all these things that you would be required to do to get somebody a loan?
Yeah, absolutely. And I can tell you of the last, I've had quite a few people who have reached out to me over the last, I would say 6 months with questions about seller financing. I am not aware of one circumstance where any of them used this form.
Wow.
So this is such knowledgeable information you guys are getting. Because people are making their own stuff up, and that, this resolves so many potential issues. I would never, knowing this form exists, I would I know it's scary, right? Because
that's terrifying. Is what I was
terrifying. There's some brokers out there who have got a problem that they don't even know about yet. One of them may or may not be you.
It better not be me. If any of my agents approach you after this training, yeah,
this is valuable.
Send them my way. Okay, let's move on to section 7. And by the way, do you guys notice that all of these concerns that Alan had earlier, we are addressing them as we go throughout this form? But this isn't something that we can skim over. This is something that you would have to do. If I were working with a buyer or a seller, considering a seller finance, I would do this same type of deep dive with them. I would spend an hour with them in this form, going through everything. There's a lot of things to consider here. There's a lot of risks. It is a serious step to take. It's not necessarily a horrible step. Like we said, there are some benefits associated with doing this, but it is a serious one where different things have to be considered. All right. So by the seller disclosure deadline, referenced in the REPC, the buyer is going to provide to the seller at buyer's expense a current credit report on the buyer from a consumer credit reporting agency. Again, there's different types of credit. So I don't know, Alan might be the better one to explain this as well, but there's free credit reporting companies out there, right, Alan, or memberships to these different companies. Those don't necessarily, I'm not explaining this very well.
No, as
Um,
a seller, considering seller financing, I think it would be wise to require that they obtain a credit report directly from a mortgage lender. The credit reports we use for mortgage lending, it's called a residential mortgage credit report. It's scored differently. It has different information on it than if they go and they get that credit from even directly from the bureaus, where they're going to get consumer-based information, or from some free system, or they say, oh, well, I can see my credit score on whatever. That may or may not be accurate. So if I was advising a seller, I would probably encourage them to require that come from a licensed mortgage lender.
yeah, that's what I was meaning to say. There's a different credit score for mortgages. Is that just a simple way to put it? Alan?
Yeah, I think that's safe. Yep, I think that's
Yeah.
the way to put it.
So yeah, so very simple way to understand this. Simple, there's a different credit score for mortgages that's considered. And so again, if it's free, or there's different companies out there that monitor your credit score, it's not necessarily the credit score that you would get if you were applying for a mortgage. And we want to know that. So again, this is at buyer's expense, a credit report. So have them contact your lender, and they'll pay that expense to the lender to have that credit run. Seller may use the credit report, the information referenced in section 6 of this addendum, that was that buyer information form, and any other information relevant to seller buyer disclosures to review and evaluate the terms of this seller finance addendum. So seller can say, look, there's a lot of risk associated here. I want the financial information sheet. I'm going to contact the current employer. I'm going to get 2 years tax returns, and I want you to talk to my mortgage lender and, pay to have a credit report run. Now, if seller, in seller's sole discretion, determines that some of those things are unacceptable, then they can, no later than the due diligence deadline. So this is interesting here, is that the seller is doing their due diligence. This isn't just a buyer doing due diligence on the home. Now the seller is doing due diligence on the financing capability of this buyer. And so no later than that due diligence of deadline, they can cancel with written notice to the buyer, whereupon that earnest money deposit is released to the buyer, or no later than the due diligence deadline referenced in section 24B, they can resolve in writing any objections that they have from their review. All right. So they can either cancel or they can resolve any objections that they have. And that might be, hey, you're a little bit higher risk, so we're going to increase this down payment by $50,000. Okay. It's all negotiable. If the seller doesn't cancel their FC, we're down to 7.2, or resolve in writing, then they have deemed to have waived the seller's review. Now, title insurance. Buyer shall or shall not provide to seller a lender's policy of title insurance. Guys, if you're going to act like a bank, then act like a bank here. So a buyer should provide some title insurance to you and pay for such policy at settlement. Now, again, it's negotiable, but my opinion, you're acting like a bank. A bank would never give you a loan without a lender's policy of title insurance. All right, disclosure of tax ID number. By no later than settlement, buyer and seller shall disclose to each other their respective social security numbers or other applicable tax ID numbers so that they can comply with federal laws on reporting mortgage interest in filings with the IRS. Here's a fun one. All right, so now you get to have a discussion with your CPA saying, hey, I'm doing seller finance on this. Here's their social security numbers. And this is another thing that we need to address in our tax situation. So again, things that you would not ever be aware of if you weren't using this proper form. All right. Now you've got contact information for buyer, for seller, if there's any additional terms that you want to have. And then of course, the standard ending right here. All right. I'm going to stop sharing the screen at this point and open this up for discussion. Any questions, comments from you guys? What are your thoughts on seller financing? It is, I'm going to say, scary if you do it wrong. Even if you do it right, that due on sell clause being exercised can be scary. I mean, we're talking about people that are struggling to get a loan or can't get a loan for whatever reason. Maybe it's just they don't want to get a loan, but they could. It's an investor that has a whole bunch of money. He could liquidate some things and he could buy it. Maybe your risk is less. And if that due on sell clause is triggered, yeah, it's not ideal for him, but he could liquidate some things and satisfy that. So that ameliorates that risk. But definitely discussions need to be had here. what are your guys' thoughts? Any questions? Alan, were there any risks associated that you had mentioned that you don't feel like that form addressed very well?
No, I think it addressed it all really well. I think it would be really important to make sure, in fact, which is great. I just think making sure that people understand what it is they're doing can be real valuable, just so that somebody doesn't come back after the fact and have a lot of frustration and anxiety because of, well, I didn't understand whatever, because it is a complex situation, and there are risks that are not standard with the transaction. So I think just making sure it's really clear would be super valuable. But that form's great. Like, honestly, it touches, I think, anything I can think of.
Yeah. And I think this is a good reason why we're recording this today, because honestly, if I were doing this and even if I were attending this training and this came up 2 or 3 months from now, my memory would be a little bit cloudy on the details. I'd probably want to come back and watch this training, maybe even pull it up in front of my clients and say, all right, let's go through this together and we'll talk about it. Cause I'm not going to be, I don't have an eidetic memory that I can remember everything that was discussed. So we could discuss this with our clients. Rebecca, you've got a question or comment.
Yeah, I just had a question for Alan. So if we, send a buyer to you, say we're sending a buyer to you and they aren't able to get financing, you would run a credit report, but what else could you tell us that besides, you couldn't get them through underwriting. Wouldn't think. Explain that to me.
Okay, well, let me just, if somebody makes an application with us as a lender, and this should be true about any lender, we're going to go in, pull in their information, run a credit report. We're going to run them through some automated underwriting tools that we use from Fannie and Freddie. And that's going to give us a response as to whether they're approved or approvable or what issues they have. If they're not fitting into that, we could also go in and say, okay, well, what if they had X income or whatever, then what it would look like? We kind of do some hypothetical stuff. Then I would get their documents. I would see where it really is, have a conversation with them about what's going on. Let's say they're self-employed and they write off every single penny they have, and they want to continue to do that indefinitely, or maybe they don't file tax returns because they're a tax protester. We've had a few of those. Or they are not legal, right? They've got great income, but they're not legal. And then what we would want to look at is say, okay, based on the circumstances that you presented, I would go back to the seller and say, here's the timeline that you need to be prepared for on the seller financing. This client, yeah, they just need to file another tax return, like Eric was saying. Maybe they need to file another 2 years of tax returns, and then they're going to be qualified. Or maybe they need to, they're going to change jobs, or whatever it may be. Or maybe it's a situation where realistically they are not going to qualify for traditional financing. And at that point, the seller can be a little more aware of what the expectation is as far as the horizon on when they're going to be carrying this note and how they would want to structure the relative risk. So in addition to the credit, I think it's really valuable to have a lender who can evaluate what's the likelihood of this person ever getting financing on their own, and what's their strategy to make that happen. Obviously my incentive as a lender then would be to work with that, now prospective client who at some point will want to refinance this and help walk them towards that. But I've definitely had circumstances where I've talked to people, and based on their situation or maybe their credit history, or just after a conversation with them and the way they've described the way they do stuff or they don't do stuff, my end of the story is they're probably not going to qualify for traditional financing unless they have, a really good co-borrow or something like that. And then that way you can just, advise the client, make a decision based on that. So we're not going to get an underwriting approval, but we can go through and do an underwriting review. Does that answer the question you had, Rebecca?
Yeah, that does.
I think that's great. I think it's fair to add in this sideline comment for Alan that he's got a fiduciary duty to any of his clients. So if they're calling him, giving this confidential information, he can't openly disclose this with other people. So that's why it's important that we've used this addendum, because it specifically says that the buyer is going to furnish the seller with this information. So they're going to go in and talk to Alan. But if I call Alan directly and say, Alan, tell me everything about this person, without some form of written instruction from that buyer, he'd be violating some rules there if he's saying, oh yeah, here's their situation. They've got this, this, and this. And so this form again is as a necessary tool that helps us get that information that we need, because the tool requires the buyer to furnish us with it. It doesn't necessarily require Alan to furnish or the lender to furnish us with their information, because he's not a signer on this contract. But we could go to the buyer and say, hey, can you instruct your lender? I would get it in writing if I were Alan, but can you instruct your lender to have a conversation and tell us everything that he's found out about this. And again, I wouldn't work with a buyer that refused to do that. You know, that's a lot of risk that I'm assuming as a seller to do a seller finance. And I wouldn't want to work with somebody that wouldn't open those doors up just as any underwriter would.
I'll just say that note, Eric, too. Before I'm going to talk to somebody who's calling me to see if they would qualify in a seller financing thing.
Yeah. Did you freeze? Did you freeze or did I freeze? Can you guys still hear me?
He froze.
Okay. All right. So there was just that one other comment he said that he has that would be absolutely vital for all of us to know. And anyways, hopefully he comes back here. But bottom line is, guys, if you're a seller thinking about doing seller financing, then you're going to want to be bold. Okay. Think of yourself as an underwriter. There are not any squeamish underwriters out there. They will all ask for the information. They're going to demand the information before they give you a loan. And so if you're acting as a seller doing seller financing, you have the right to know all of these things. And if you're an agent, don't sugarcoat it and don't make excuses as to why they may not want to get these things. Oh, it's your mom, it's your brother, it's your sister, whatever. Okay. This is business. This isn't family. You know, if it's a friend who, you know, well, I know he's really good at his business, so I'm not even going to question it. Doesn't matter. Question away. Okay. Alan's getting back on. Let's see if he can connect here and finish his thought. All right, Alan, you got disconnected there. What is your, what was your thought?
My computer died. Before I'm going to talk to somebody calling on seller financing, the first question that I would ask them as a lender is, would you authorize me to share any information we discuss with the seller of the property? And, you know, please send that to me in writing, Eric, like you mentioned, via email or text us. We've got that, because otherwise it's not super helpful to anybody.
Right. Right. Absolutely. Thank you, Alan. Okay, guys, we're going to go ahead and wrap it up today. Thank you for joining me. I hope this was beneficial to you. Like I said, I've gotten a lot of questions in this market about seller financing. So now we have a deep dive on seller financing. We have a separate deep dive on lease options. They both can accomplish the same goal, which is getting somebody into a home that couldn't qualify right now or doesn't want to qualify right now for whatever reason. And there's benefits to both. So check those out. And again, we will hopefully do some more of these fun meetings in the future. Thanks again, you guys, and take care.
Thanks, Alan and Eric.
Hey, you're welcome.